If you've been looking at Melbourne's northern suburbs and you're torn between Mill Park and Broadmeadows for your next investment, this video will settle it once and for all. I'm Gilbert, and I just spent the last week analyzing 47 different data points across both suburbs to determine which one actually delivers better returns for investors. Look, I get it. You're probably seeing Mill Park everywhere. Auction clearance rates, family appeal, that hot market buzz. Meanwhile, Broadmeadows keeps popping up in your searches because of the price point. But you're wondering if there's a catch. The problem is, everyone's got an opinion on the Melbourne property market, but nobody's showing you the actual numbers. I'm a data analyst and the founder of SuburbsMinder, a data tool that's used by thousands of investors, buyers agents, and mortgage brokers across Australia. I spend my days analyzing property data across Australia's 15,000 plus suburbs, and today I'm going to show you exactly how these two Melbourne suburbs stack up across every metric that actually matters. Let me start with the numbers that'll grab your attention immediately. Median price. Mill Park sits on a median house price of $820,000 and Broadmeadows is only $610,000. That's a $210,000 difference, enough to completely change your borrowing capacity. What's even more interesting is that over the past 12 months, Mill Park has grown 4.46%, adding about $35,000 in value. Broadmeadows has grown 7.02%. Now, before you think, case closed, Broadmeadows wins, there's something in the rental data that completely changes this equation. Let's talk about cash flow. Mill Park rents for $540 per week, giving you a gross yield of 3.42%. Broadmeadows rent for $495 per week, with a yield of 4.22%. On paper, Broadmeadows gives you an extra $4,160 per year in rental income. But here's what the numbers don't show you. Mill Park's rent has jumped 8% in the last 12 months compared to Broadmeadows' 5.32. Think about it like this. If you're buying an $820,000 property in Mill Park, you're getting $540 per week now. But that rent growth trajectory suggests you could be looking at $580 plus within 18 months. Meanwhile, Broadmeadows' slower rent growth means that cash flow advantage starts shrinking over time. Of course, cash flow and price are not the complete picture. You also need to assess what supply and demand is looking like, especially if you're investing for the long term. Mill Park has 3,123 potential buyers actively searching. That's up 15% year-on-year. Broadmeadows has 1,305 potential buyers, which is up 46% year-on-year. Now, you might think, smaller numbers, who cares? But look at the supply side. Mill Park has 36 properties for sale, down 33% from the last year. Broadmeadows has just 17 properties for sale, down by 45%. Now, when demand is growing faster than supply is shrinking, you get price pressure. Broadmeadows is showing all the early signs of a suburb about to tighten significantly. And the sales data back this up. Properties in Mill Park are selling 36 days, Broadmeadows in 38 days. Virtually identical despite the $210,000 price difference. But again, before you start thinking Broadmeadows is the clear winner, you might also want to consider the demographics. So, let's talk about who's actually living in these suburbs, because this determines your client quality and long-term growth potential. Mill Park has a median household income of almost $2,000 per week, while Broadmeadows sits at $1,284. That's a $651 weekly difference, or about $33,800 per year. More importantly, Mill Park is 75% owner-occupiers, 25% renters. Broadmeadows flip that, 47% owner-occupiers and 53% renters. Here's why it matters. Owner-occupier heavy suburbs tend to be more stable, have better maintained properties, and attract families who stay longer. But renter-heavy suburbs can offer better yields, faster tenant turnover when the market's moving. Now, I have to address the elephant in the room: crime. There's a lot of chatter online about Broadmeadows' safety. So let's look at the actual numbers. Mill Park scores 10 out of 100 on the crime index. Extremely safe. Broadmeadows sits at 37, which sounds higher, but it's been steadily improving. So, up until now, we have covered price, rent, and demographics. But there's one more piece of the puzzle I want to share with you: infrastructure. This is where Broadmeadows, in my opinion, starts to look really interesting for forward-thinking investors. The Melbourne Airport rail link is coming, and Broadmeadows is right in the path. We're also seeing the Botanical Village Town Center development, which is a 51 to 100 million project plus major warehouse developments. Mill Park, on the other hand, is already well serviced. You've got Westfield Plenty Valley, the South Morang train line, Plenty Road tram, and RMIT Bundura. It's mature infrastructure, which is great for stability but limited upside. Think of it this way: Mill Park is like buying a fully renovated house. You're paying for what's already there. Broadmeadows is like buying a house in an area that's about to get a major infrastructure upgrade. You're buying for the potential. So, which one comes up on top? Here's my take based on the data. If you're a first-time investor or someone who wants to sleep well at night, Mill Park is your suburb. Higher entry price, yes, but stable demographics, strong owner-occupier base, established infrastructure, and consistent performance. If you're an experienced investor with a higher risk tolerance and you understand the area, Broadmeadows offers compelling upside. Higher yields now, stronger recent growth, major infrastructure coming, and all the signs of the market that's about to tighten significantly. But here's what I'd actually do. I'd buy in Broadmeadows, but only if I could secure a property under 600,000 in a street that's walking distance to the future rail link. The infrastructure upside combined with the current yield makes it a compelling 3 to 5 year play. Mill Park, I'd buy if I found something under 800,000 that had a granny flat potential or subdivision opportunity, ways to manufacture additional yield or growth. The reality is, both suburbs can work, but they suit different investor profiles and strategies. The key here is having access to this level of data analysis before you make a decision, not after. If you want to run this same analysis on other suburb comparisons you're considering, I've built Suburbs Finder specially for this purpose. It tracks all the data points I mentioned today across every suburb in Australia, updated monthly. You can access a free trial through the link in the description. It'll let you filter suburbs by your exact criteria, compare multiple locations side by side, and track changes over time so you can spot opportunities before they hit everyone else's radar. The data is there, you just need to know how to read it.